He flipped a $12.9 million jet for a profit after 3 years and 800 hours of flying, and now wants to shove the money into his own AI real estate startup. And yes, we're talking about Meet Kevin. Welcome back to the comment section with Thomas Paul, where we take YouTube finance stories, squeeze out the drama, and see what's actually left in the glass. So Kevin just dropped a video titled something along the lines of "Why I Just Sold the Jet," where he says he bought a roughly $12.9 million private jet in December 2022, flew it for his startup and himself for about 3 years, more than 800 hours, and somehow sold the plane for more than he paid. Then he pivots right into, "I'm taking this capital and going harder into House Hack and Reinvest AI." And by the way, he thinks his private shares at $1.40 are insanely cheap. Let's see what holds up, what's tax magic, and what's YouTube marketing in a pilot's headset. First, the jet flip. Kevin's core claim is pretty simple. He buys a jet for around $12.9 million, uses it heavily for business and personal travel, then years later gets multiple offers above his original purchase price and accepts one of them. On the surface, that sounds impossible, because in most normal universes, jets are like luxury cars with wings. They lose value over time. But private aviation in the last few years has not been normal. If you look at data from jet brokers, General Aviation Manufacturers Association reports, and firms like Jetcraft and Guardian Jet, the COVID and post-COVID era saw used jet prices spike. Demand went nuts because wealthy people wanted to avoid commercial flights, and supply of good late-model aircraft was tight. Some high-demand models actually did trade above their pre-pandemic valuations, especially if they were already in service and ready to fly. Factor in that you can't just walk into a dealership and grab a new jet off the lot. Lead times are long, backlogs have been reported in industry press. So for certain aircraft, the lightly used market became a bidding war. So is it theoretically possible that Kevin chose a desirable model in late 2022, flew it, and later sold it for a couple $100,000 more than his purchase price? Yes. In weird markets with supply constraints and heavy demand, that kind of appreciation on the hull price can happen. But here's where the framing gets slippery. When you say, "I flipped a $12.9 million jet for a profit," you're inviting people to picture house flipping. Buy low, sell high, walk away richer. Jets are not that. Even if the sale price is higher than his purchase price, you still have crew salaries or contract pilots and training, hangar fees and parking, maintenance, inspections, parts, and surprise repairs, insurance, fuel, a lot of fuel, financing costs if he leveraged it. Industry estimates often put all-in operating costs for a mid-size or large jet in the thousands of dollars per flight hour. Multiply that by 800 hours, and you're comfortably in 7 figures of operating costs, sometimes multiple millions depending on the plane and how it's managed. So from a pure asset price standpoint, yes, he might have won on the resale versus what he paid. From a total economic standpoint, did he profit overall on owning that jet for 3 years? Almost certainly not. He paid a fortune to operate it, even if some of those costs were business expenses. Verdict on the airplane flip itself. It is directionally plausible that he sold the aircraft above his original purchase price in a tight, tax-juiced market. It is also very marketing-friendly to call that a profit without mentioning 3 years of 7-figure burn to keep the thing in the air. Let's talk about why there was so much demand in the first place, because this is where he brings in tax law and that big, beautiful bill that supposedly brought back 100% bonus depreciation for aircraft. Kevin's argument is basically Congress juiced bonus depreciation that brought back effectively full expensing on jets. Buyers wanted that tax break, so demand for qualifying aircraft spiked, and that pushed his jet price up. What does the IRS actually say? Under the 2017 Tax Cuts and Jobs Act, the U.S. did allow 100% bonus depreciation for certain qualified property, including business-use aircraft, placed in service after late 2017 and before 2023. That meant a business that bought a qualifying jet and used it predominantly for business could, in many cases, deduct the entire purchase price in year one. But that party started to wind down. Bonus depreciation began phasing out. 80% for property placed in service in 2023, 60% in 2024, and so on, dropping by 20 percentage points per year. A lot of tax advisories from big firms and aviation-focused CPAs have been warning clients about this phase down for years. There have been legislative attempts to extend or restore higher bonus depreciation in different forms. Some bills and tax packages have floated tweaks, and in certain narrow categories you can still get strong expensing, but it's not as simple as bonus depreciation is back forever, go buy a jet. And even when 100% bonus depreciation is available, it is not free money. It accelerates deductions you would otherwise take over time. You're moving tax savings up front, not changing the ultimate economics of buying a jet. It comes with strict business use requirements. If you don't use it primarily for qualifying business purposes, you can get in trouble. If you sell the aircraft or your use changes, you can be hit with depreciation recapture, meaning the IRS claws back some of that benefit as taxable gain. So yes, high-income buyers absolutely do respond to these incentives. If a wealthy business owner can buy a jet, write off most or all of it immediately, and combine that with real business travel needs, they might be willing to pay a premium. That can absolutely push up demand for late-model aircraft that qualify and can be delivered fast. But that doesn't mean the jet is a magical money printer. The tax code is basically letting you time-shift your tax bill. It's powerful, and in the right hands it can make sense, but it doesn't turn every aircraft into an investment the way a rental property is. Verdict on the tax boost explanation. He's not making the bonus depreciation concept up. IRS guidance and big tax firms' memos back that part. The simplification is in presenting it like this clear, forever green light, when in reality it's a phased, conditional benefit with traps if you don't follow the rules. I'd file his version under YouTube summary, not tax planning. Now, why does the jet story matter? Because he uses it as a pivot. I sold this for a profit, and now I want to pour more into house hack and reinvest AI. So let's unpack the house hack pitch. Kevin says a broker-dealer valued house hack and its Reinvest AI arm somewhere in the $1.40 to $2 per share range back in August 2024. At that time, according to his framing, the business had more staff, was less profitable, and had no AI ambitions yet. Now he says they've cut costs, crank money, and are building what he claims could be the best real estate AI in the world. The implication is, if the valuation was that high back then, it must be an absolute steal to buy shares now around $1.40. Here's the reality of private valuations. When a broker-dealer or valuation firm gives an opinion, it's usually for a specific fundraising round with specific assumptions based on the information the company provides. It's not the same as a public market price where millions of independent participants trade the stock every day. Those private valuations can quickly become stale. Markets move, interest rates change, competitor landscapes evolve, and the broker-dealer doing the work is being paid by the company raising money. That doesn't automatically make it garbage, but the incentive is to get the round done, not to lowball the founder and scare everybody off. Also, more profitable today plus we have AI now does not automatically mean the equity is more valuable. To support a higher valuation, you need evidence. Growth, margins, defensible tech, customer traction, and an environment where investors want that specific risk. For retail investors, the key point is when the founder is showing you a valuation range and then telling you the shares are cheap relative to that, you should treat it as marketing. If an independent investor with no ties to the company is buying a ton at that price, maybe that's interesting. When the issuer is the one hyping the number, it's a pitch. Verdict on the $1.40 per share cheap narrative. Totally normal founder behavior to be bullish and talk up a past valuation as validation. Not something you should treat as an objective price target. Private company stock is illiquid, high risk, and extremely concentrated. The fact that the per-share price sounds low in dollars doesn't tell you whether it's a bargain or a bubble. He then compares this to buying public stocks, gold, Bitcoin near all-time highs versus buying more house hack. The vibe is, why would I buy the S&P at highs or Bitcoin after a run when I can buy my own private company at $1.40 that could tanks or 100x? Let's de-romanticize that. Blue-chip public stocks and major ETFs are regulated, have to file audited financials with the SEC, trade every weekday with transparent prices and massive liquidity, have decades of performance history and diversified revenue streams. Startups, or early-stage, thinly capitalized companies like House Hack, are the opposite side of that spectrum. Limited public disclosures. No liquid market for shares. You can be locked in for years or indefinitely. High chance of business failure. Even VC-backed companies with big-name funds backing them often go to zero. Statistically, early investors in small private companies are taking huge risk for the possibility of a very asymmetric payoff. That's not evil. It's just the rules of the game. But to compare adding to an S&P 500 ETF or buying a little gold as dumb versus YOLOing into a single private deal because the price per share looks cheap is not an apples-to-apples comparison. In a broad index, you're diversified. If one company implodes, you barely notice. In a single startup, if it implodes, you're done. Verdict here: if you want to be an angel investor in Kevin's company because you believe in him and the vision, fine, that's your choice. Just don't confuse that with buying a boring, liquid, diversified index fund. The risk profile is completely different, and the possibility of a total loss is dramatically higher. Now, the Reinvest AI hype. Kevin markets Reinvest AI as potentially the best real estate AI in the world, trained on his personal experience and data. He positions it as a kind of secret weapon for finding and underwriting real estate deals better than anyone else. Reality check. The real estate AI race is not an empty field waiting for a guy with a YouTube channel. You've got huge players: Zillow, Redfin, CoStar, CoreLogic, large brokerages, institutional investors, already using machine learning and AI models for valuation, risk scoring, lead scoring, you name it. There are startups specifically focused on AI-driven underwriting, automated deal analysis, construction cost estimation, and rental optimization. Many of them have raised serious capital and have deep data partnerships. Could Reinvest AI carve out a niche? Possibly. There's room for specialized tools. Could it become the best real estate AI in the entire world? That's a marketing superlative, not an empirically verifiable statement. What a lot of founders are doing right now is attaching AI and best in the world to their pitch because investors are excited by those words. That doesn't mean there's no substance. It just means those phrases aren't something you can underwrite against. You can't build an investment thesis on a slogan. Verdict: be very wary of phrases like best, number one, or world-leading when they come from the person selling you the equity. Treat them as branding, not facts. Ambition is fine. Investment decisions should be based on traction, economics, and verified capabilities, not the CEO's confidence level. Next, let's touch the more subtle stuff: courses, tax write-offs, and that juicy 5% yield. In different videos and sales materials, Kevin has suggested that many people can treat his course memberships or educational products as a tax write-off, and that investing into House Hack at around $1.40 comes with something like a 5% yield. On the tax write-off point, whether you can deduct education or subscription costs depends heavily on your specific tax situation. The IRS generally allows deductions for ordinary and necessary expenses of carrying on a trade or business. If you're a real estate professional or run an investing business and you buy education that genuinely improves or maintains skills in your current business, that can sometimes be deductible. On the other hand, if you're a W-2 employee or a casual investor taking a YouTube course hoping to maybe someday buy a rental, the rules get a lot stricter. Also, unreimbursed employee expenses lost a lot of deductibility in recent years. IRS guidance and tax pros are very clear. You don't just slap education on every course receipt and magically lower your taxes. So, can some viewers legitimately deduct his memberships? Yes, in specific qualified circumstances. Is that something you should assume is true for you because a creator says, "My course is a write-off"? Absolutely not. That is what your CPA is for. On the 5% yield, House Hack's offering documents, as described in their materials, talk about certain preferred returns or distribution targets tied to investor capital. But this is very different from a bond or a savings account. A preferred return is something the company aims to pay if there is distributable profit and cash flow. If the business underperforms, those distributions can be delayed, reduced, or suspended. It's not FDIC insured, it's not guaranteed, and there is no central bank stepping in if House Hack's deals don't pan out. Another nuance: some structures accrue unpaid preferred returns, so on paper you earn 5% even if no cash shows up until an exit, which could be many years away or might never happen. Verdict on the tax and yield talk: it's possible that what he's saying is technically correct in narrow best-case scenarios, but it's extremely easy for an average viewer to misinterpret write-off and 5% yield as free tax savings and safe annual income. That's dangerous. Always run both your tax assumptions and your understanding of a private deal's payout structure past a professional before you put serious money in. Let's land this plane. Kevin's jet story. In the context of the last few years' jet market and bonus depreciation rules, it's not insane that he sold the aircraft for more than he paid. A tight supply of desirable jets plus buyers racing for tax benefits can absolutely generate above-purchase offers. But the real economic story of that jet is, he paid a ton to fly it, likely got significant tax advantages, and then exited the asset at a favorable price. That's not a clean profit flip. That's a very expensive, tax-optimized lifestyle and business tool that he wrapped up nicely. And now, the main event is not the airplane. It's the pitch. I'm moving that capital into my company, House Hack and Reinvest AI. The shares are cheap. The AI is world-class. There's a nice yield. And hey, maybe some of my products are a write-off. Founders are naturally biased toward their own projects. They should be. If Kevin wasn't wildly bullish on House Hack, that would be a red flag. Your job as a retail investor is to recognize that bias, separate the entertainment from the underwriting, and set some ground rules for yourself. Don't treat creator marketing as independent research. Don't confuse private startup equity with boring, diversified index funds. Don't assume AI plus real estate equals automatic multi-bagger. And don't build your tax plan from YouTube sound bites. If you're interested in deals like House Hack, demand the docs. Read the offering circulars, look for financials, understand the capital structure, and ask what happens if things go badly, not just if everything goes to the moon. And for most people, if a single creator-driven private deal is more than a tiny slice of your overall portfolio, you're taking on a lot of concentration risk. None of this is investment advice. I don't know your situation. I'm just the guy in the comment section pointing at the numbers. All right, I want to hear from you. Do you buy the jet flip as a legit profit? Or is that just good storytelling on top of a very expensive toy? And would you ever invest in a YouTuber's private company? Or is that a hard pass? Drop your thoughts down below. Tell me what you want fact-checked next. And if you like having a slightly sarcastic adult in the room when the finance hype starts flying, hit subscribe before you go.